When your mortgage repayments become unaffordable, most people think they have two options: pay it or don't. There is a third option most people don't know exists, and it's called loan restructure. And while it can provide real payment relief, the numbers behind it are something every homeowner needs to understand before they make that call. Central banks respond to inflation by lifting the official base rate, and when that happens, variable rate mortgage repayments go up, sometimes significantly, and for many households carrying large mortgages, even a modest rate increase can create real pressure on the monthly budget. A loan restructure is one of the options available when that pressure becomes unmanageable. But here is what most people don't realize, that while it's an option, a restructure isn't just a free solution. It has a cost, and that cost shows up in two places: how long you will be paying off your loan and how much interest you will pay over its lifetime. Understanding those numbers, quite important. And if you're new here, welcome. I'm Nova. I have spent over 15 years inside the banking industry as a credit risk professional. On this channel, I cover personal debt and lending through a risk lens, and everything here is purely for financial education and is not meant for personal financial advice. My goal is just to help you understand how the system works so you can have more informed conversations when they matter most. And there is one thing in this video I want you to hold in the back of your mind as we go through this. It will make a lot more sense once we get to it. Something about what a loan restructure can mean for your credit report and how that sits alongside the alternatives if things go further. Most people are genuinely surprised by this, and we will get to it. But first, let's understand how variable rate mortgages are designed to work, because this is where the story actually starts. When you take out a variable rate home loan, your interest rate is tied to the lender's rate, which is influenced by the central bank's or RBA cash rate. And when the central bank or RBA lifts rates, lenders typically pass some or all of that increase onto variable rate borrowers. Your repayment goes up, and here is something important that most borrowers don't fully appreciate at the time they take out their loans. When a lender assesses your borrowing capacity, before they approve the loan, they don't just assess whether you can afford repayments at the current rate. They assess whether you can afford repayments at a higher rate. And in Australia, lenders are required to apply a serviceability buffer, currently a minimum of 3 percentage points above the actual loan rate, when stressing your ability to repay. What that actually means in practice is this: if your loan rate is 6.25%, the lender assesses your capacity to repay at 9.25% or above that. That buffer exists because rates change, and the expectation built into the system is that borrower should also carry some capacity to absorb those changes. But life doesn't always follow the assessment. Income can change, costs can rise, and sometimes the buffer is not enough. When that happens, a loan restructure may come into the conversation. So maybe to just understand what this loan restructure is. So a loan restructure is a formal modification to the term of your existing loan agreed between you and your lender. The most common form for mortgages is extending the remaining loan term. And by spreading the remaining balance over a longer period, the monthly repayment reduces because you are paying the same debt back but more slowly. It's not the same as a payment pause or hardship deferral. A restructure changes the actual terms of the loan on a longer term basis. Banks assess restructure requests on case-by-case basis. Approval is not automatic. The lender will look at your financial position, the reason for the request, and whether the restructure genuinely improves your situation in a sustainable way. And here's what I want you to understand before we look at the numbers. A restructure is just a tool. Like any other tool, it has its right use cases. And like any tool as well, it has consequences that go beyond the immediate relief it provides. Let me show you exactly what those consequences look like using real examples. I'm going to use a straightforward example. A 1 million home loan at 6.25% over 30 years. At those terms, the monthly repayment is approximately $6,157 over the 30-year life of the loan. Total interest paid comes to approximately 1.2 million. That is the cost of borrowing that money over that period. Now, let's assume 6 months in, the central bank or RBA has lifted rates. Inflation is running high. The lender passes on a 75 basis point increase. The rate then moves from 6.25% to 7%. And after 6 months of repayments, the remaining loan balance is approximately 994,000. There are 354 months, just under 29 and a half years still to run. That 75 basis points move from 6.25% to 7% creates a fork in the road. And the path chosen here has a 659,000 difference attached to it. I will come back to that number. The first path is the one the loan was designed for. Repayments adjust upward to reflect the new rate, and the loan continues on the same 30-year term. At 7%, the new monthly repayment on the remaining balance is approximately 6,600. That is an increase of 491 per month, or roughly 5,888 per year. On a 1 million loan, that is a meaningful number for many households. But the loan stays on track. The total interest paid over the full loan life rises to approximately 1.39 million, an increase of around 174,000 compared to the original projection at 6.25%. That additional cost reflects the higher rate running over the remaining loan life. Scenario B is where loan is restructured to keep the original repayment. The borrower cannot absorb the 491 increase. They approach their lender and request a restructure to keep the repayment at the original 6,157 with the loan term extended to accommodate the higher rate. The lender assesses the request, approves it, and extends the loan at 7% with a monthly payment of 6,157. The remaining term required to pay off 994,000 is approximately 489 months. That is just over 40 3/4 years remaining. The total loan life from the original start date becomes approximately 41 1/4 years. The original loan was 30 years. The restructure has added approximately 11 1/4 years or 135 months to the loan, and the total interest paid over the now 41-year life of the loan, approximately 2 million. Compared to scenario A, where repayments adjusted, the restructure costs approximately 659,000 more in total interest. That is the number I mentioned earlier. And it's not because the restructure is wrong, but it's a number everyone should see clearly before making the decision. Let me just pull those three scenarios together clearly. Original loan at 6.25%, monthly repayment is 6,157. Total interest is 1.2 million. Scenario A, rate rises to 7%, repayments adjust to 6,600, increase of 491 per month. Total interest, 1.39 million. In scenario B, rate rises to 7%, loan restructured to keep repayment at 6,157, loan extends by 11 years, total interest is 2 million. One important note on these numbers: this is a simple loan amortization model. It doesn't take into account offset accounts, redraw facilities, additional repayments, fees, or individual lender differences. Real outcomes will vary. These numbers are just here to illustrate the mechanics, not to predict your specific situation. Now, here is the part I mentioned at the start that most people are genuinely surprised by. In Australia, when a loan is formally restructured on a longer term basis, this appears on your credit report under financial hardship information section. Financial hardship information is only retained on your credit report for 12 months, after which time then the information is removed from your credit report. This information is visible to other lenders who review your credit file during that 12-month period. And this is where context matters, because the credit report conversation around restructures has two sides. Consider what the alternative looks like if someone reaches the point where they genuinely cannot meet their repayments and a default is recorded. Under credit reporting law, a formal default listing stays on your credit file for 5 years from the date it's first listed. This is 5 years visible to any lender reviewing your file, which can affect your ability to access credit, refinance, or apply for new products during that window. For some borrowers, a restructure agreed proactively with their lender before reaching that point may represent the better outcome when weighed against that 5-year default consequences, not because restructuring is without costs, as the numbers we've just looked at clearly show, but because for some people in genuine financial difficulty, it may be the most manageable path available to them at that point in time. And this is exactly why lenders assess restructure requests individually. The circumstances matter, the timing matters, and the outcome that protects both the borrower and the credit relationship in the long run is what a good lender is trying to find. Knowing that it appears on your credit report for a period is important before you request a restructure, so there are no surprises later on. And if you have questions about how a restructure may be reported in your specific situation, that is a conversation worth having directly with your lender or a licensed financial professional before making the decision. So what can you do with this information I'm sharing? If you are in a position where your mortgage repayments are becoming difficult to manage, here is a practical framework for thinking through your options. The first step is understand your current position, know your current interest rate, your remaining balance, and your remaining loan term. These 3 numbers tell you exactly where you stand and give you a baseline for any conversation with your lender. Step 2 is that calculate what a rate change actually means for your repayment. Even a basic online mortgage calculator will show you what your repayment would be at different interest rates. Running this calculation yourself before speaking to your lender means you go into that conversation informed rather than reactive. And the third step is that know that a restructure is one of several options. It's not the only tool available. Other options may exist depending on your circumstance. There are publicly available resources that outline these options clearly. They are worth reviewing before you make any decision. If in Australia, Credit Smart and Money Smart are publicly available resources. And the fourth step, if you do consider a restructure, ask your lender these specific questions. How will the restructure be reported to credit bureaus? What will the new term be? What is the total interest I will pay over the remaining loan life? If my situation improves and I want to increase the repayments to reduce the impact, how would that look like? Getting these answers gives you a clearer picture of what the real relief actually costs. And step 5, if you're uncertain, seek independent guidance. A licensed financial counselor can help you assess your options in the context of your specific circumstances. As I close, I just want to say that a loan restructure is a legitimate option within the financial system, designed to help borrowers manage through periods of genuine financial difficulty. But like every financial decision, the relief it provides has a cost attached to it. The numbers we just walked through today show exactly what that cost looks like in loan term, in total interest, and in what it means for your credit report. Understanding those numbers gives you the information to have a better conversation with your lender, with a financial counselor, or with yourself. If this helps you see the mechanics more clearly, share it with someone carrying a variable rate mortgage who might need to see this. And subscribe, because next week we are going into your credit report itself. What the 4 main sections actually contain, how long different types of information stay there, and the part of the report most people have never even looked at. Thank you.